First of all, welcome. My name is Ken Gee. I'm the owner and managing member of KRI Partners. Before we get into our seminar or our webinar, let me just take a minute and thank Lance and Brittany and everyone at Verivest for giving us this opportunity to talk about this fund. And it's my understanding that I'm the first of many, so hopefully this one goes off just fine, and there are many more good ones to come. So special thanks to both of you for all your help, and to Verivest for allowing us to showcase our fund here. We're really excited about that. All right, so by way of intro, let me just say that we're giving away a free ebook that you might be interested in. It's really on point for what we're talking about here, and that is multifamily real estate is truly a total game changer. I believe that, so much so that I wrote an ebook about it. You can get that ebook by going to kripartners.com/ebook. And of course, you just got to give us your name and your email address, and then we'll shoot you a link to download it. But I believe that you can build massive wealth as a passive investor. Hopefully that's why a number of you are here, because you believe the same. Now, this ebook is, I'm really excited to be able to offer it for two reasons. One, the first part of the book really addresses a question that I think every single person sitting in your chair has to face, and I faced it at one time myself. And that is, you know that there's a ton of money to be made in real estate. You just got to figure out how you're going to get your share. So in the first part of this ebook, I walk you through this process of looking at, should you buy a duplex? Should you buy a single family? Should you buy an apartment building? Can you buy an apartment building? Or should you be a passive investor? So I take you through that whole process and helping you look at the various types of real estate and figure out how does real estate fit into your life. Now, the second part of the ebook, and it assumes that, like most people, you've decided that passive investing in real estate is probably the best thing for you. Making that assumption, I get into what something is, and Lance can certainly give more insight than I can on this, but try to give you some insight into how the fund world works, how the sponsor world is, so that you can help vet, so you know how to vet sponsors and figure out which sponsor is one that you should invest with, which one aligns best with your goals and your objectives. So the first part of the book kind of gets you through that process of figuring out how you're going to participate in this process called real estate. And the second part of the book is, assuming you've gone with passive investment, which is right for most people, how do you go about vetting sponsors like us and figure out which is the right one for you? Again, kripartners.com/ebook is how you download that. You know, and I think just by way of reminder, you know, 3 deals. We'll talk a little bit about them later. But these are Verivest verified deals. Clearwater internal rate of return on that deal we did was a little over 32%. A deal we just closed on in Orlando, a little over 38% IRR. And in Jacksonville, a little over 23% IRR. I don't know about you, but I consider that to be a sort of game-changing returns, especially if you're a passive investor. All right, so let's think about for a minute what your goals probably are, or what kind of environment we find ourselves in right now. And the way I look at it, we know that inflation is right around the corner. In fact, it's probably here now. We know that there's a ton of volatility in the markets. I know that being an active trader can be a lot of work. I know it's certainly not for me. There are a lot of folks that do it really well. I would not be one of those people. And generally in this environment, there seems to be a disconnect with a lot of different asset classes between the value of that asset and its ability to generate cash flow. So I only point these things out because I'm trying to set the stage for the environment that I think we're in today in terms of investing. So, all right, let's think about what your objectives probably are as as an investor, so to speak. If you could find the perfect investment that checked off all these boxes, it might be one that you should pursue. First of all, you'd want cash flow out of your investment. Secondly, you'd love to have some appreciation. Tax benefits would certainly be nice. You should always have an investment that's easy to understand. and that's based on a proven investment thesis. It should be something real. We prefer something that's real that you can actually touch because it tends to do better in inflationary environments. Um, you're hopeful that this investment that you're about to make is going to actually make a difference in your portfolio and help you to build significant wealth. When I think back at all of these things, these are a lot of asks. But the critical piece of this is you don't want to take on a ton of risk, right? I can get all of these things in one investment. I sometimes have to assume a lot of risk. Well, let's talk about that for a minute, because I think we're going to show you why that isn't the case. I will tell you that I looked everywhere trying to solve this problem, and I just couldn't find a better answer to this than multifamily real estate. That's why I wrote the ebook. That's why I spent most of my professional life in this business. And therefore, I built a company around this whole concept, and I called it KRI Partners. And I'm certain I'm not the only guy to reach this conclusion. All right, so let's talk about how we do things and what we do. So we buy BC class assets in growing metropolitan areas in good neighborhoods that, if we make some physical improvements and some management improvements, that will make those assets more valuable than they are today. These improvements that we make are going to allow us to rent to better quality tenants, to significantly improve the cash flow of the asset. So as long as we're able to do that, they fit into our investment thesis. Now, let's go back to our checklist, right? Because I want to relate what we do to that checklist of things that I think are important in an investment. First of all, does multifamily real estate get it done in terms of cash flow? It does. If you properly manage it, it could provide a very stable, diversified revenue stream with fairly predictable expenses. It's not perfect, but if you do it right, you can get a pretty good income stream from a very diversified source of residents with fairly predictable expenses. Does real estate appreciate? Does multifamily appreciate? Yeah, it absolutely does. And one of the reasons I like it most is because it's fairly predictable in terms of its pricing. If I can increase the cash flow of an asset, then I'm pretty sure I'm going to be able to make that asset worth more, and people will be willing to pay more for it, right? Especially when you consider our business plan, which is a value-add business plan. See, in the real estate world, value is determined based on its ability, that asset's ability to generate income. Are there tax benefits? Yep. Now, of course, right now, I think a lot of folks would challenge these assumptions because there's so many proposals before Congress about eliminating some of our depreciation and other tax benefits. But I'm hard pressed to think that all the benefits that we enjoy as real estate investors are going to go away. So I think at the end of the day, we're going to be left with some tax benefits and maybe even everything that is currently in place. We'll have to see, but definitely it checks off that box, I think. Is real estate easy to understand? It is. I mean, everybody has lived in an apartment or knows somebody who's lived in an apartment. You know what a nice property looks like, feels like. It's really pretty easy to understand. You collect rent, you pay expenses. It seems pretty straightforward. So it definitely checks off that box. Is this multifamily investment based on a proven investment thesis? Yeah. I mean, like I said in the beginning, everybody knows you can make a ton of money in real estate. People have been doing it for decades. And I think you all know that most wealthy people have credited a significant amount of their wealth to the fact that they've invested in real estate. Can you touch it? Yeah, I don't think I need to go into too much there. Does it make a difference in your portfolio? Well, here's what I would ask you. Would 15, 25, 35% IRR or annual rates of return make a difference in your portfolio? I can guarantee you it makes a difference in mine, that's for sure. So it's these types of returns can generate massive wealth with real estate. Now, it does take time to do that, but you could certainly get there, no question about it. So we've gone through the checklist, and it's pretty clear that real estate checks all the boxes. Hopefully everybody agrees with that. All right, but what about risk, right? So I keep talking about risk, but I haven't really addressed it yet. So can you earn these types of returns without enduring crazy levels of risk? And my answer to that question is yes. And it goes back to why we do multifamily. If you think about all the different real estate asset classes, there is one thing that I can't figure out how to change, and that is that every one of us as human beings need a place to live, right? So if everyone needs a place to live, in my world, in my mind, that puts the apartments world or the multifamily investment world at the relatively low level risk continuum of this asset class, right? So we've got a relatively low risk asset. It's not 100% risk free, but it certainly is lower risk in terms of alternative investments. And if you can earn 15, 25, 30% annual returns on a relatively low risk asset, I call those extraordinary risk adjusted returns. So I think it absolutely makes a lot of sense to pursue multifamily real estate. And again, we know with the current market and how focused everybody is on buying real estate right now, that I'm pretty sure I'm not the only guy that thinks that. I go back to, I still cannot find a better risk return investment. I just can't. And as long as we can get 20, 25, 30% annual returns, I'm pretty sure I'm going to be doing this for a very, very long time. All right, so let's talk about, so for many of you, this will be fairly remedial, but for some of you, I think it's important to at least take you through the process of how we earn these huge returns, right? We're going to assume, let me go through an example. Granted, it's going to be fairly simplified, only because I would take too long to nail down all of the various assumptions I would need to. So let's take this in a simplified way. Let's look at a 100-unit property in Tampa. This is typical for our deals. The average rent is currently $800 a month. Let's say we bought that property for 10 million bucks. Let's say it's at a 5% cap rate. We'll get into cap rates in a minute, but for now, let's assume it's a 5% cap rate. We got to put $2.5 million down, typically 75% loan to value, and so 25% equity. And we're going to put another $500,000 down because we want to renovate this property and make it nicer. We're going to hold this property for 3 years. And when we do that, because we're on the ground every day, because we do our homework, visit our rent comps, visit neighboring properties, we know that we're going to, after we make these improvements, we don't know, but we're darn sure we're going to be able to move rents to $1,000 a month. So that's the assumptions for this example. So let's look at the effect on value, because this is why you get such crazy, impressive returns with multifamily real estate. So in my example, we took rents from $800 to $1,000 a month. That's $200 a month. That's a 100-unit property. If you take that times 12 months, we're at $240,000 of additional cash flow that this property now has because of what we've done. So let's figure out how much is that going to increase our value. It's going to increase. So let's take the $240,000 increased cash flow. We're going to divide that by the 5% cap rate. We're going to adjust that cap rate in a minute. So stand by for that. And if we do that, that means we're going to move that value of that property by $4.8 million because we were able to generate that much more cash flow. So did we make 4.8 million on this yet? No, we didn't, because we got to invest. We did have to invest $500,000, if you recall in our example, to make that property nicer in renovations. So we have to take that away from the 4.8 million. That means our real profit here is about $4.3 million. Let's figure out the investor's return. I'm not going to do IRR because that's going to be too complicated, but let's do annual rate of return. So in that 4.3 million, a typical syndication fund model means it's an 80-20 split on the profit between the investors and the sponsor. So we'll make that 80% assumption here. We divide that by the $3 million that we had to invest, divide that by 3 years. That puts us at a 38% annual return on our investment. Now, I've forgotten one thing, and that is in our fund and in a lot of syndications and funds, the sponsors will pay a preferred return. We're no different. We do a 7% preferred return. I call that getting paid while you wait sort of thing. So we have to add that because it's a 7% preferred return annually that's paid out of the cash flow of the property. That's in addition to the 38% that we earned on the sale. We actually have to add that to our annual return. That takes our total annual return to 45% annually. That's some crazy returns. I don't know about you, but I certainly don't mind seeing those kind of returns at all. All right. Now, I know many of you have said, well, but Ken, rates are going up. You can't assume that you're going to buy it at a 5 cap and sell it at a 5 cap. And you're probably right. So let me take you through the sensitivity analysis that we do when we look at deals ourselves. Everything in this example is exactly the same, except I change one thing, and that's the cap rate. I move that cap rate from 5% to 6%. When I run through the math, that takes our 45% annual return down to a 38%. Still not bad, right? Interest rates moved a whole 100 basis points, but we're still doing pretty well. Finally, we do a, I call it a world goes crazy, right? Worst case scenario, cap rates go to 7%. Now, I can't remember the last time Florida deals, that's where we do business, traded at a 7% cap rate, but let's pretend like rates go crazy here. And I need to know what's going to happen to our investor returns if that does in fact happen. Again, everything is the same except the cap rate. That takes our annual return down to 33%. Now, I have left out some important things here that I want to bring to your attention. The first is there's always some sponsor fees associated with this. There's always going to be some broker fees, some sales costs, things like that. So if I take that 33 and let's say I shave 5 points off of it, just to account for that. If you're in the high 20s, that's still a pretty good return on a relatively low risk asset as such as apartment buildings. So hopefully that makes sense. That's how we're able to take our improvements, our increases to rental rates and turn them into really huge profits for our investors. Hopefully that makes sense. All right. We still want to focus on this risk issue, right? I keep bringing it up because I think you need to always keep it in the front of your mind. How do you minimize that risk even further, right? I said really a multifamily is basically at the lowest, one of the lowest level in terms of risk assets for real estate. Let's think about how we can manage that risk even more. And this is where Verivest comes in. I will tell you that the role that Verivest plays in our fundraising efforts and just in our ability to help our investors vet us is absolutely critical. The role that they play in this industry, I think, is critical. So when you are able as an investor to look at a sponsor's track record like ours, and you can see how much experience we have, and you can see what we've done, you see the good, bad, and the ugly, you see everything, right? It allows you to figure out how to find that experienced management team who can lead your investment, which is actually a business. It's an apartment building, but it's really a business, through a pandemic, through a financial recession that we had in 08, 09, through whatever it is that's coming around the corner that we don't know yet, right? You want to make sure that the management team that's in place managing that asset and that you've invested with has the necessary experience to figure out how to navigate these waters. And again, I go back to the pandemic. We made huge operational changes to make sure that we were doing just fine through the pandemic. And you want to have a sponsor that has that level of experience. And between, well, basically looking at the Verivest site and our page on that site, you can see that we've been around for a long time, and certainly other guys and gals have as well. All right, so let's talk about KRI for a minute. It's a founder-led firm. I own the firm. I started it back in 1997. We specialize in BC multifamily value-add deals. We've talked about that. Here's the experience piece. Our senior management team has managed more than 15,000 units. About 11,000 of those have been in Florida. We've personally owned 15 different properties. You can see our track record on Verivest. We're very proud of it. And again, our investors have earned up to 20, 25, 30% annual ROI on deals in the past. So let's talk about the fund, right? This is supposed to be a webinar that talks about the fund. I wanted to give you some background as to why we're doing what we're doing so that it all fits together and it makes sense. So let's talk about our fund in particular. Let's talk about why we selected multifamily. Well, actually, I'm not going to beat that up anymore. I think I've beat that up enough. Secondly, why do we like the Southeast, more specifically Florida? And then why invest in our fund? So again, I think we're checking off all the boxes there. I'm not going to spend any time on that. But let's talk about Florida for a minute, because everybody says, oh, Ken, it's such a hot market. Why do you want to be there? Well, there's a reason it's a hot market. we know that about 1,000 people move into the state of Florida every day. Now that's net in migration. That's net of people dying. That's net of people moving out. That's net in migration to that state. Some of those people are wealthy. Most of those people are not. Most of the people are just coming there to pursue jobs, better quality of life, lower taxes, more affordable housing. There's a thousand different reasons to move to Florida, right? No pun intended with 1,000. Now, everybody says to me, Ken, they're building like crazy in Florida, and you're correct. They are building like crazy. But what are they building is more important than the fact that they are building. They're building A-class properties. We don't do A-class properties, right? We do BC class properties. So the A-class properties that they're building is fine to serve the maybe 25% of those 1,000 people a day that are moving in, that it meets that need just fine, right? But those rents are $3,000, $4,000, $5,000 a month, and they're pretty high, right? Those are not properties that a normal, ordinary person can usually afford or really wants to move into. That's why we do BC class properties. They are not building those properties. So what happens is you have, think about your economics, back to your economics days in college, you've got increasing demand and you've got stable supply. That automatically puts upward pressure on rents, right? More people want the product than is available. That means prices are probably going to go up. So that's a bull market. I call that a bull market. When I put our value add strategy on top of that, that's why and how we get crazy returns like what we've reported to you so far. You're really layering a bull market and a value add strategy on top of each other. In order for Florida to stress me, I have to see one of those two things changing. And I don't see people not moving to Florida anytime soon. This has been going on for a very, very long time, and there's still a ton of land left in Florida to move to. And secondly, I don't see the cost of construction coming down so low that they can afford to build BC class assets. So I don't see that demand supply situation changing anytime soon. That's why I'm really continue to be very excited about Florida, and that's why we're there. All right, so let's talk about why are we forming a fund. Most people are used to the syndication model. I talk to investors every day who are considering our fund, and some have even asked me, Ken, it's so much easier if I just knew what building I was investing in. Well, let me tell you why we've made that jump to a fund. In the syndication world, you find the deal, then you go raise the money. But here's the problem with finding the deal. You have to lock that property up. Sellers know that syndicators haven't raised the money yet, most likely, and that they know that there's maybe it's not super elevated, but it's definitely an elevated chance that that fund or that syndicator won't be able to raise the money and that they may have to get the property back. Now, compare that to a fund situation. We're now switching it around. Remember I said you find the deal, then you get the money. We switch it around. We get the money, then go find the deal. We're going to find the exact same deals that we have for 23 years. And we've even put case studies out on our YouTube channel so that you can see exactly what properties we've done, what we did, how and why we made money. So now when we go and approach the market, which is clearly a competitive buying market, sellers that work with us know a few things. One, the equity raise risk is off the table because we've already raised the money. That gives them a lot of comfort knowing that if they go under contract with us, that risk is gone. Secondly, their fund managers are generally more experienced, not always, but most of the time. Most people early on in their investing career start off as a syndicator. So they know they've got more experienced buyers, and they know that we've probably fine-tuned our due diligence process and so on and so forth. So they at least perceive that the buying process, or for them, the selling process will be a lot smoother than it could be if it wasn't a fund buying it. So we're in a competitive market. That's why we've chosen to go the fund route, because we need to find a competitive edge. Now, it's even more important because we buy in the smaller property space. There are almost no fund managers running around chasing down 75, 100, 125, 150 unit deals. they're almost all going for the big stuff, right? So that means that we're a fund manager operating in a smaller market, in the smaller size market, competing against syndicators. So presumably we have an advantage there because we've already raised the money. And we can presumably close pretty much quicker without closing extensions and things like that. In terms of the rest of the terms of the fund, our business strategy, we've already talked about that. It's value add, and you know how we're going to do that. You know we're focused in Florida. Oh, the asset hold period is generally 3 to 5 years. People always ask me, why are you only holding 3 to 5 years? You know, our goal is to go in, improve the asset, prove it, take it to the next level, leave some meat on the bone for the next guy or gal, and then sell the asset. If we hold the asset too long, we run the risk that we overstay our improvements, right? We outhold our improvements, and then we have to do them again. Our improvements tend to be several $100,000, not something that I want to repeat because I held it too long. All right, our target for the fund is 15 million. We're over 10. We're somewhere between 10 and 15 right now. I'm happy to report. I didn't mention this yet, but this is really our last call tour. We're gonna close this up. We're close to getting a couple of deals here, and as soon as we do, we're gonna do one close and one close only. The minimum investment in the fund is $100,000, and we can only admit accredited investors, or obviously I wouldn't be able to have this conversation with you here in this public forum. As a fund manager, I'll personally invest between $500,000 and $1 million in the fund. The document requires I commit 5% of the minimum, so it's at least $500,000, and it could go up to $1 million depending on how big the fund gets. When we underwrite our deals, we're looking for a 15% annual return. And remember, that's not guaranteed because there's no guarantees anywhere in this investment world. But when we look at our underwriting, we're looking for an overall return, annual return of 15%. And again, I mentioned this earlier, we pay our investors a 7% preferred return. So what's important is when we sell assets, our investors get all their money back, they get their preferred return, and then only then do we get into the promote with the 80-20 split with us, with the fund manager. Now, something that's important, syndication people are used to a deal by deal waterfall, meaning the sponsor gets paid every time a deal is sold. In the fund world, that is not how it happens, at least not our fund. I don't get our bonus. We don't get our bonus until you've gotten all your capital back for the entire fund. Let's say the fund's 15 million in capital has to be returned before we start the split. And you have to have been paid all your 7% preferred return. In terms of the fee structure, when we set this fund up, we tried to mirror a syndication fee model because everybody was familiar with that. Typically the syndication model is a 2 and 20 model, 2% asset management fee. What we did is we took each one of those fees and just tried to lower them a little bit because we're not here to make money on the fees. We're here to make money at the back end. That's our goal. So our asset management fees, 1.5 on called capital. And then we have an asset and a disposition fee. It's 1%. It's 1.5% if it's a really small deal, but I'd be shocked if we did a deal small enough to make that kick in. Something important, most funds have a commitment fee. We do not have a commitment fee. We have the asset disposition and acquisition fee instead. Doesn't make sense to me that I would charge you for the opportunity to commit to our fund when I haven't deployed a single dime of your money. So that's why we don't have a commitment fee with our fund. I would ask that you please take a look at the PPM. You know, as with all these investments, there's a lot of little details that you need to take a look at. Way too much for me to bore you with on this webinar, but I need you to read the PPM and you'll see the waterfall laid out in great detail for you. All right, why invest with us? First of all, experience, right? We've already talked about that. I don't think I have to beat that up anymore. Personally, I think it's important that you know who I am and my background. I'm a CPA. I spent 7 years at Deloitte. I'm also a licensed real estate broker in Florida and the state of Ohio. Although I don't list or sell anything, I only do it so we can do third-party management. That's the only reason I'm a licensed broker, and I don't take any fees out of any of our deals because the broker world would just never even let you do that. Commercial loan officer, I spent 5 years at a local regional bank in Northeast Ohio. So my CPA background, my M&A background, and my commercial loan background really helps us in our underwriting process. I also, it's really unrelated, but I own 3 Cessna pilot centers for a period right before 9/11. It was a lot of fun to run a business like that. Definitely, no question about it. Master's accountancy from Case Western Reserve, a small private school in Cleveland, and my undergrad is from the University of Toledo in finance. All right, our track record, reason number 2, why you should invest with us. It's on the Verivest site. I'm not going to spend any time on this because I'm certain you know how to find it there. We're just really proud of our returns. Please know that some of those crazy returns early on, it's because we use leverage pretty liberally. We don't do that anymore. But when you really use leverage a lot, you can get some crazy returns. So just know that things are a little bit skewed by some of our earlier investments where we did not have outside investors in our deals, and we weren't afraid to lever them up, which is not something I would do with this fund. So pay attention to that. Okay, our core investment discipline. I think it's important for you to know if you're going to invest with us, kind of how are we thinking? What are we doing here? First thing, making honesty, integrity our foundation of everything we do. I can only hope that every company that you work with can make that statement. It's important to me, if you look carefully at our fund terms, that I have worked really hard to try to make sure that our goals are aligned with yours. I think that's really important. Please make sure you look for that when you're trying to vet your sponsors. Next, complete transparency is really important to me. Obviously, our commitment to the Verivest concept should hopefully demonstrate that. In terms of regular reporting, we do quarterly reports about 30 days after the end of the quarter. That includes your P&L, your balance sheet, the rent roll, and I also write up a narrative on every property that we have, talking about exactly what's going on. Where are we at with the renovation? How are things going operationally? How's our rent increases going? And we usually track our rents relative to our projections, so you always know where that's going. So the next thing I think that's conceptually. The next thing I think that is important is our underwriting process, right? So I said I was a CPA and a commercial lender, so you should probably expect my underwriting to be fairly detailed, and it is. We do all of our underwriting from the bottom up. We don't use book numbers, book averages. Oh, I think expenses should be X% of income. We just don't do that. We don't do that because I can use those methods on 3 different properties and get 3 incredibly different results. So about 22 years ago, I stopped doing that. So we do the real hard work of underwriting from the bottom up. Our due diligence, and I think sellers appreciate this, it's focused on what's important and what matters. It's pretty extensive due diligence. It's efficient and focused and focused on the things that we think matters. And so that helps us a lot because the broker community knows that we're not going to go chasing down a bunch of things that just don't matter to the deal or to mitigating any risks. We're always going to develop multiple exit strategies on our deals just because you don't know what's going to happen. Typically, it's a sale in 3 to 5 years. It could be, we know what's going to happen if we have to hold it longer. We could contemplate a refinance and getting everybody all their money back. That's less likely. Our preferred way to exit a deal is always to sell, but we want to make sure that we look at the various scenarios so that we understand. The last thing I want to talk about here on this underwriting process is exiting in a timely fashion. So many guys and gals will put a lot of stock in how many units do you have, right? I have 10,000 units. I have 15,000 units. And I will tell you that our goal for this value add fund is to add our value and turn the asset and make you money. That is not consistent with building massive unit counts. Our goal is to turn the asset and return the money to you and make money. So we are constantly evaluating how and when we should exit a property. An example, our underwriting always goes out 5 years, but the Jacksonville deal, if you recall, we sold that almost 4 years. The Orlando deal, which is actually in Orange City, It's a suburb of Orlando. We sold that after 2 years and a month because we felt that we were as far as we could take it without a whole new round of capital be invested. So the point to take away from that comment is that we are not going to bring you into the fund and then hold these assets for eternity just so that we can build you an account. Our goal here is to turn it and make money for you. All right, execution. I talked about the fact that our senior management teams managed more than 15,000 units. It should come as no surprise then that I believe that execution really, really matters, right? You can have an awesome plan, but if you don't know how to execute that plan, you're really not going to do very well. So we've got that experience. The other thing that we do, or one of the other things that we do, is we are constantly reevaluating our plan. It's so many times I hear people say that they went in with a plan and they never changed it, right? And I think they do that because new sponsors are concerned that their investors might not be comfortable with them if they see them changing their plans. Well, I'm here to tell you that on almost every single deal, our plan changes all the time. Now, there usually aren't wholesale changes, but there are little modifications here and there because we're constantly evaluating what we're spending against what we're going to get for it so that we make sure that we're using your capital as efficiently as we can. And that requires us to constantly revise our plan. And again, our goal is to maximize the result with the minimal inputs. And those inputs, from your perspective, are really our capital. In general, we don't over-improve. We always renovate our properties from the outside in. Think of the Jerry Maguire movie. Everybody laughs at me when I say, you have me at hello. That's what we're going for. We love to make the approach to our properties nice. We love to expand on amenity packages because we know those amenity packages really grab people emotionally, and it gives us a little more pricing power when we're talking to prospective renters. Everything we do, we're focused on maximizing revenue. Even when we're renovating a property, we're almost always well over 90%. We do that because we don't go in and empty out the property, renovate it, and fill it back up. That's just never what we do. In Florida, our properties or our units turn about 30, 40, 50% a year. I don't know how many more units in a year you need to turn, but that's plenty for me. So we're turning that rent roll maybe 2 to 2.5 times in a 3-year period. That allows us to renovate at a steady pace and that make it a super major project. And it allows our leasing people to lease us up without having to try to figure out how to lease 20, 30, 40 units all at one time. So that's a little bit about execution and what I think sets us apart there. Let's see here. All right, our target markets, we're getting close to the end here, don't worry. Our target markets, I think it's important that you're entrenched in your markets. This little map I did here is definitely missing some bullet points. It's several months old now, but we're definitely entrenched in all of our markets, and that's critical so that you understand the market and you're ready to go when the deals are ours. The last reason I think you should always invest with us, and I have a family. I have 2 kids, actually 3, 2 of my own, 1 stepdaughter. They've all just graduated from college. I understand why you invest, right? You invest for your family, you invest for your retirement. I always make sure that everybody in our company understands that. So that, that's a little abstract, a little touchy-feely, but I think it's important because I think a lot of times in our business, people lose sight of that. But that's really why you're here. That's why we're here. We're all doing this for the same reason. All right, so that really wraps things up. I will remind you, this is our last call tour, so to speak. If you're interested in that ebook, KRIproperties.com/ebook. I'm sorry, KRIpartners.com/ebook is how you can get that. Reach out to me if you have questions, kg@KRIpartners.com. Go to our website or call us at 813-489-9666. And I'm happy to open it up for questions here. I'm running this thing solo, so do me a favor, raise your hand if you have questions you want to talk, or just hit the chat box. If not, otherwise, we can certainly connect with you offline and answer your questions privately, which is oftentimes what a lot of folks like to do. Thank you very much for your time, your attention. I know I went on for quite some time. I appreciate it very much. And again, thank you to Veravest, Brittany, and Lance for giving me this opportunity to talk about our fund. And hopefully there'll be many more opportunity webinars after this one.